Greetings everyone. So continuing to the notional COA, we already discussed 14 points till the last session. Now we move on to the 15th one, that is transfer of new assets acquired for claiming the exemptions. That is, it includes section 54, 54B, 54D, 54G and 54GA. It provides exemption from the capital gain tax if the SSE reinvests the capital gain in specified new assets such as residential houses, agricultural land, industrial assets, or assets which are shifted due to some industrial relocation, maybe because of various reasons. However, these exemptions are conditional. One important condition is that the newly acquired asset should not be transferred within a specified lock-in period, generally, which is generally 3 years, taken to be 3 years. So, if the SSE transfers the new assets within this period, the exemption earlier claimed becomes taxable indirectly through adjustments in the cost of acquisition of the new assets. So what happens in these cases? So in such cases, the cost of acquisition of the new asset will be actual cost of acquisition minus the exemption claimed earlier. Okay, so this actually reduces the cost. This reduced cost increases the taxable capital gain at the time of transfer of the new asset. For example, suppose a person purchases a new house for rupees 20 lakhs. Okay, now he claims an exemption under section 54. Which is equal to rupees 8 lakhs. Now, so his house will be sold, suppose his house is sold within 3 years, then his cost of acquisition as per the exemption claimed will be 20 lakh minus 8 lakh, because he has claimed this, obviously he qualifies the section 54, only then he can claim for this of rupees 12 lakh. So the purpose of this provision is to prevent the misuse of exemptions through short-term reinvestments. Okay. Then next we come to goodwill, trademark, brand name, business rights, tenancy rights, stage permits, and maybe loom hours also. Actually, see, certain intangible assets may not have a clearly identifiable acquisition cost because they are often self-generated over time. For example, maybe goodwill of a business or profession, trademark, then we have the brand name, we have right to manufacture or process, then business rights, tenancy rights, stage carriage permits, loom hours, etc. The law provides very different rules for them depending upon the manner of acquisition. For example, if we talk about the assets purchased from the previous owner, if suppose these intangible asset was purchased from any previous owner, then the cost of acquisition will be the actual purchase price paid by the SSE. Maybe, for example, suppose trademark being purchased for rupees 5 lakh, then the CO will become 5 lakh. Sometimes, for example, if these assets are purchased from the previous owner, then maybe sometimes there are different instruments used for calculation also. For example, goodwill can be computed on the basis of the profits or supernormal profit that are earned. So, that way we can do it. Similarly, suppose if the assets are acquired under section 49(1). If that is, if the assessee acquired the assets through inheritance, gift, or succession or amalgamation, etc., covered under section 49(1), and the previous owner had originally purchased those assets, then the cost of the acquisition will be the purchase price which has been paid by the previous owner. So we take into consideration the price which is paid by the previous owner here. So this maintains the continuity of cost across the transfers. Then there is another point that should be taken into consideration, and that is about the self-generated assets. In all other cases, particularly where the asset is self-generated, the cost of acquisition shall be taken as nil if it is self-generated. For example, self-generated goodwill or of a business, or maybe self-created brand reputation. Since no actual acquisition cost can be identified here, then the Act, always Income Tax Act, treats COA as nil. So this ensures that the entire sale consideration becomes taxable as capital gain. So, these are the three situations which we must always remember when we buy, and when it is self generated or self-generated asset, that is we have acquired, or when it is taken from where the previous owner also purchased it from somebody else. So what COA, how the COA is determined. So these are some notional points that must be taken into consideration. I hope this is clear to all. Next we have the right shares. That is when a company issues additional shares to its existing shareholders. Such shares are known as right shares. If the assessee subscribes to the right shares by paying the required amount, then the cost of acquisition shall be amount actually paid by the assessee. For example, right shares subscribed for, suppose they are subscribed for rupees 1 lakh, then COA is equal to, or cost of acquisition is equal to 1 lakh. This is because the shareholder has incurred actual expenditure to acquire the share. Okay. So this is about the right shares. Then we have right to subscribe to share, that is right entitlement. When we talk about this, actually what happens is that sometimes instead of subscribing to the right shares, the shareholders may transfer or renounce the right entitlement itself to another person. Since the right is received without any acquisition cost, the law provides that the cost of acquisition of such right entitlement shall be nil. Therefore, the entire amount received from the transfer of the right entitlement becomes the taxable capital gain. Let's say right entitlement is sold for rupees 50,000, then CO will be nil obviously, and the entire 50,000 will be the taxable capital gain. Next we have the bonus shares. Bonus shares are additional shares issued by a company to the existing shareholders, which is free of cost out of accumulated reserves. Since shareholders do not pay anything for acquiring bonus shares, special rules are actually prescribed for determining their costs of acquisition. So, bonus shares which are allotted, so there are different situations, okay, two situations, that is bonus shares which are allotted before 1st April 2001 and bonus shares which are allotted after 2001. So, first we will talk about bonus shares allotted before 2001. So, here the cost of acquisition will be the FMV, that is fair market value of the shares as on 1st April 2001. So, Actually, this provision aligns with the base year substitution mechanism introduced for pre 2001 assets. Now, what about the bonus shares which are issued post or after 1st April 2001? Here the COA will be nil because no payment was made to acquire such share. Here we do not take into consideration any COA or notional basis, only it will be considered as nil. So, suppose bonus shares are sold for 2 lakhs, COA will be nil and therefore the entire amount will be payable as capital, not payable but taxable as capital gain, rupees 2 lakh. So, this is how the situation, or maybe with the provisions after 2001 and provision before 2001. The last point, which talks about shares and trading rights which are received on demutualization or corporatization of a stock exchange. So, actually here earlier the stock exchange, it functioned as mutual organizations where members simultaneously enjoyed the ownership rights and trading rights. Okay, after corporatization and demutualization, members received equity shares of the stock exchange company and separate trading or maybe the clear rights. Okay, so in order to determine the COA in these cases, there are some special rules which have been prescribed. That is, first is about the cost of acquisition of equity shares, and second is cost of acquisition of trading or clearing shares. Okay, so in a first case, that is your cost of acquisition of shares, equity shares. What do we have? COA of shares allotted under the demutualization shall be the cost of acquisition of the original membership card of the stock exchange. For example, a membership card originally purchased for rupees 10 lakh, then rupees 10 lakh become the COA of equity shares which have been received. So, similarly, in case of cost of acquisition of trading or clearing rights, the COA of trading or clearing rights will be taken as nil. This is because such rights arise automatically from corporatization and are not separately purchased. They are not separately purchased. So, these are the points that explain the different notional COAs. Okay, moving on to next, that is unit of business trust acquired under section 47, subsection it is 17. So, this section specifically deals with the transfer of shares by the shareholders in exchange for units of a business trust, such as a real estate investment trust, REIT, or maybe we can say REIT, or maybe we can say of infrastructure investment, that is INVIT. So, what happens in such transaction is that the shareholder does not purchase the units directly with money. Instead, the units are allotted in consideration of transfer of shares to the business trust, and therefore the law provides that the COA of the units of the business trust shall be the COA of the original shares that were transferred. So, this provision ensures continuity of investment cost and also avoids creation of artificial gains merely because the form of investment has changed. We can understand it better with the help of an example. For example, shares which were originally purchased for rupees 4 lakh, suppose, and share which are exchanged for these shares were exchanged for a unit of a business trust. So here what will happen, this rupees 4 lakh becomes the COA of the units received. So this provision has been applicable from the assessment year 2015-16. Please remember that. Before that, this provision was not available. It has been there since 15-16 only. Coming to the next, that is unit allotted on consolidation of mutual fund scheme. Mutual fund sometimes consolidates 2 or more schemes into a single scheme, maybe from the point of view of administrative efficiency or investment efficiency. So in such cases, the unit holders receive units in the consolidated scheme in place of units held in the earlier schemes. Okay. So since the investor does not newly purchase the units, the law provides continuity of the cost. So accordingly, the cost of acquisition of units allotted in the consolidated scheme will be deemed to be the cost of acquisition of units held in the consolidated scheme. For example, units in old scheme purchased for rupees 2 lakhs and new consolidated units are being allotted of the same amount, then rupees 2 lakh becomes the COA for the new units. So this provision ensures that consolidation does not result in unintended tax consequences. Main objective is that consolidation should not result in unintended tax consequences, maybe positive or negative, whatever. The next item in the list is shares which are acquired on the redemption of global depository receipts, GDRs. Under this, the resident investor may hold the gold depository receipt, GDRs, which represent the share of Indian companies traded in foreign markets. So such GDRs may later be redeemed into the actual equity shares of the Indian company. Since here the investor does not directly purchase the Indian shares, the law prescribes a special rule for determining their cost of acquisition. So under this provision, the COA of shares obtained upon redemption of GDRs will be calculated based on the price prevailing on a recognized stock exchange on the date on which the redemption request was made. Please remember this, this is important. This provision is intended to ensure, maybe because we always find it ensures the fair valuation and it also I think facilitates accurate taxation of gains arising from subsequent transfer of such shares. Because these are sometimes there is no fair valuation, or maybe valuation goes wrong, or there is no accurate calculation of the taxation because of the gains that is arising. So whatever, this provision checks all those things. It is a measure for that. Maybe we can understand it better with the help of an example. For example, suppose GDR redeemed into Indian shares market shares, and the market price on the recognized stock exchange on the redemption request will maybe it is equal to rupees 500 rupees per share. Then rupees 500 per share becomes the COA, and it will be calculated accordingly. So this provision applies to non-resident SSE who are covered under section 115 AC subsection 1 para B. So this is how this section provision rectifies the situations. Now we come to the last part, that is last notional COA. Now here it maybe we can say it talks about any other capital assets which have not been discussed. It's though we have discussed a very comprehensive list, but this includes this last point number 24 includes anything that does not come above, included above. So for assets which are not specifically covered under the special provisions, then the Income Tax Act provides a general rule for them. Maybe they take into consideration the date of acquisition and mode of acquisition. These are the 2 points which is to be taken into consideration in order to work on the COA or maybe decide upon the COA of anything. So the first is there are various sub points as you can see on your screen, A, B, C, D. So first we will discuss about the assets that are acquired before 1st April 2001, maybe through gifts or through will or inheritance, etc. And it is the section 49 subsection 1 that handles this part. So if the assets became the property of the taxpayer before 1st April 2001, through the modes specified under section 49 subsection 1, for example, maybe gift, inheritance, succession or partition. It also includes trust transfer. Then the COA will be the cost to the previous owner or the fair market value as on 1st April 2001, whichever is higher. Okay, whichever is higher. And this allows actually the SSC to substitute the FMV as on 1st April 2001 if it is not beneficial. Okay. Then we have the second point that talks about the assets which are acquired before 1st April 2001 otherwise than section 49(1). That is whatever does not come under the section 49 subsection 1, here it is included here. So if suppose if the taxpayer directly acquired the assets before 1st April 2001 through purchase or any normal mode, then the COA will be actually the actual cost of acquisition. It will be the actual cost of acquisition or the FMV as on 1st April 2001, whichever is higher. I think we have already discussed this. I explained you on the previous session. So this provision was, was introduced because, as I have already said, the 2001-2 has been shifted as a base year for the capital gain computation. And for the cost inflation index CII table also. Okay. Coming to the third point, point C, which talks about any assets which are acquired on or after 1st April 2001 through gift, will, etc. So if the assets became property of the taxpayer on or after 1st April 2001 through inheritance, maybe gift or other section, maybe for means other section 49 subsection 1 mode, then the cost of acquisition shall simply be the cost to the previous owner. No FMV substitution benefit is available here because the acquisition has already taken place after the base year. Okay. Then we come to talk about the last point of this, that is point number D, assets acquired on or after 1st April 2001 through purchase. I think this is comparatively a simpler case where the taxpayer directly acquires the asset on or after 1st April 2001, then the cost of acquisition will be the actual actual purchase cost incurred by the SSC. Obviously, whatever will be purchased whatever, for whatever amount they have purchased, it will be your COA. This is the normal rule applicable in the most ordinary transaction. Okay. So these are all about your these points in this about the notional COAs. But there are some important notes. I think before closing this topic, I would like to just throw some light upon. For example, terminal depreciation and balancing charge. So, there are power generating units. Power generating units may claim depreciation under the straight line method instead of block asset system. So, therefore, a special provision apply when such depreciable assets are sold, discarded, or demolished or destroyed. Two concepts, and because of this, two concepts become very important. And this we have it in the table above about the terminal depreciation, that is power generating units. So here there are two concepts that become very important to understand. First is what is a balancing charge and what is a terminal depreciation. Balancing charge arises when the sales consideration is greater than the written down value, or we can say balancing charge is equal to sales consideration minus written down value. The excess amount will be taxable in the relevant year. So this is how we compute the balancing charge. And then terminal depreciation, it arises when your written down value is greater than, that is vice versa. It is greater than the sales consideration. So the formula is terminal depreciation is equal to written down value minus sales consideration. So this amount is allowed as deduction while computing the taxable income. Actually, the purpose of these provisions ensure a proper, let me just cover up the whole thing, COA, notional COA, and the depreciation and everything. That is, this provision actually ensures proper adjustment of depreciation already claimed during the earlier year, and therefore they prevent excess tax benefit or excess taxation when depreciation or depreciable assets of power generating units are transferred. So finally, this is all about the notional COA. So let us just conclude here that these provisions relating to the COA, I think we have gone through a very detailed session on this, and therefore they illustrate a very detailed and adaptive framework of the Income Tax Act for taxing the capital gain. So we do not leave these provisions or these rules, they do not leave any loopholes. Whether the asset is acquired through inheritance or restructuring or consolidation or demutualization, or maybe it is a business trust or GDR redemption, etc., or it may be your corporate reorganization, the law provides very specific rules to determine an equitable and consistent cost basis. So such provisions ensure continuity of taxation, it prevents double taxation, and it avoids the manipulation of acquisition cost while maintaining the fairness in the capital gains computation system. So that means it leaves no loopholes. It puts before us all checks and balances, all measures that should be taken while calculating the COA, whether notional or actual, and therefore it leads to accuracy. So we discussed this much in this session. Thank you very much. Thank you.